So welcome once more. So in this video, we're going to focus on transactions, accounting transactions, and how those transactions affect the basic accounting equation. So as you will remember, your basic accounting equation is made up of your assets, right? So your assets being equal to your equity, right? So that's going to be your basic accounting equation. Assets is equal to your equity plus liabilities. All right. And now we're going to focus on this aspect of owner transactions. So basically, your owner transactions are going to be your drawings and capital transactions. All right. The capital contributions by the owner, as well as the drawings that are done by the owner. So those we refer to as owner transactions. So what is going to guide us in our owner transactions is a principle that is referred to as the entity principle. Now, the entity principle says in accounting, we're going to record the transactions of the business only. In other words, we're not going to record the transactions that the owners enter into. So if I can give you a quick guideline. So the owner of the company, all right, can go and borrow money from ABSA, all right. But according to the entity principle, we're not going to record that transaction because it's the owner that went to borrow. The business did not go to borrow. We only record that transaction if it was the business that went to borrow that money from ABSA. In other words, we're just focusing on the entity only, not on other parties. There could be transactions between the entity and other parties, but as long as the entity is not affected, did not enter into that transaction, as long as the entity is not party to the transaction, we're not going to record that. So we have owner transactions, which means that the owner can have dealings with the business. All right. So when the owner is dealing with the business, we're going to record that because the business is being involved. So that's our entity principle. And we're going to focus on how those owner transactions affect the basic accounting equation. All right, so the first owner transaction that we look at is a deposit. So there's an owner who is Mr. Molloy, right? So he made a deposit of 100,000 into his business bank account as a capital contribution to start his business. So what we do is that we stand in the perspective of the business. So the business has received money from the owner. So that's an owner transaction. Okay. So now, as you know, we said to you earlier, all right, not earlier, but in other recordings that we've shared with you, right, in other previous sessions, if I can say it like that. So I've said to you in our previous sessions, we've said it's very important for you to be able to read a transaction and then be able to see which accounts are being affected. So if you look at this, there is a bank account that has been affected. There's also a capital account that has been affected. So we now need to do what we refer to as general ledger entries. In other words, we want to record this in their separate accounts. And we're going to use the principle called double entry system. Right. So if you haven't gone through the double entry system recording, I would advise you to go through that particular recording because we also shared it with you. And I believe that it's also one of those recordings that we have shared on YouTube as well. So double entry means, so just a quick reminder, because we've already explained double entry. Just a quick reminder. Remember that Earlier on, we identified assets, we identified equity, we identified liabilities. So under equity, we also identified capital, drawings, income, and expenses. Right. So here you have assets, then now we have liabilities. All right. And so just a reminder, so you need to know accounts that fall under assets, because if any account that falls under assets increases, right, we have to debit that account. And so just a quick reminder, we have what we refer to as a debt. So this is something that accounting students use to remember. So these are the accounts that we debit if they increase. All right. So if expenses increase, we're going to debit them. If assets increase, we're going to debit them. If drawings increase, we're going to debit the drawings account. So any account that falls under assets, if the account increases, we're going to debit the account. Right. Because in accounting, we have a general ledger account like this. It has a debit side and a credit side. Okay. So a debit side, if you are supposed to debit this account, you're going to record the amount this side. If you're supposed to credit it, you're going to record the amount this side. There are also recordings where we focus on the construction of general ledger accounts. All right, so they give you a better understanding of this. But what we're focusing on now is how these transactions affect the basic accounting equation and the general ledger entries. Right, so we say so these are the accounts that you're going to credit if there is an increase. So you have to credit that. So if it is a liability, it's increased, then you have to credit the liability account. You have to put the amount on this side. If we have more income, we've received more income, then that income account, maybe it's a dividend, that amount should be put on the debit side. Remember, each account will have its own separate separate account, if we can say like that. So each item will have its own separate account. We won't have all the income being recorded under one account, right? We have to distinguish. If it is sales, it has its own account. Interest income, its own account. So every time an item or an account of income increases, we're going to go to that particular account and credit it. The same applies to capital. So that was income. The same applies to capital. Okay, so what we need to do, remember that if you have gone through our recordings on YouTube, you remember that we said the most important step in accounting is to identify the accounts and their categories. All right, so that was, so if you go through this particular transaction, you identify the business bank account, and that's an asset account. All right, a bank account is an asset account, and capital is equity. So if you look at this transaction, the amount in the bank has increased by 100,000. And bank is an asset. When an asset increases, you have to debit. So if you go to the bank account, you're going to make a debit entry of 100,000 because the amount in the bank has increased by 100,000. And bank is an asset. So when an asset account increases, you have to debit that asset account. And it's also, you go to capital. So the owner made a deposit of 100,000. He increased his capital contribution. All right. So capital also increased. And when capital increased, it falls under the click. Right. So you have to credit the capital. So when you make entries in the general ledger, right. So if I can just quickly also touch on what a general ledger is. So a general ledger is like a huge folder, right? So let's say you are a student. All right, we also have explained this under the construction of the general ledger, but if you might not have gone through that first, because these are recordings, you might appreciate a quick idea into what a general ledger is. So a general ledger is like, let's say you are a student, all right? So a general ledger is a huge folder that you have on your laptop. Then on that folder, then you're gonna have a module FAC 1503, which you study. Then a PVL 1501. All right. So that's a subfolder, right? So you have a huge folder here. Then you have subfolders for your then you have a CMY 1501. Okay. Then if you open this, all right, FAC 1503, then you can have a learning unit 1, right? Learning unit 2, learning unit 3, and so forth. So this is like a general ledger. All right, you have a general ledger is this big folder. So if you open your general ledger, then you have accounts that fall under assets, under equity, under liabilities. If you open that asset account, then you can find land account, you can find buildings. So under buildings, you can click on buildings or right on land, then the account opens. Now, because you bought more land, you just have to go to that land account, right? Right. So it opens like this. It really doesn't open like that, but this is what it will appear like. Because you bought more land, land has increased. You put the amount here. All right. You have debited land account, but this land account is in the general ledger, the big folder, which is subfolders and individual items. Right. So this is just an attempt to try and make it clearer to you. All right, so we're going to debit bank in the general ledger. We open the general ledger. We go to the bank account. When the bank account opens, on the debit side, we enter 100,000. We then go to the capital, all right, account. Then we enter 100,000. All right. So later on, we're gonna show you how this is done using journal entries. All right. Okay. Using a journal. Because a journal is the one that is used to post this to their respective accounts. Now, if you look at this, we want to look at the effect of this transaction on the basic accounting equation. How has this transaction affected assets? How has equity been affected? And has liabilities been affected as well? As a result of this transaction, do we owe people other than the owner? Not, we don't, right? So the bank is an asset. It has increased by 100,000. So assets have increased by 100,000 as a result of the bank account, because the bank account falls under assets. So the total assets is swelled up rather by 100,000. But also it was a capital contribution, right? So as a result, there's an increase of 100,000 on equity. So what your examiners want is that you could put a not applicable here and a 0 under this position, because your liabilities were not affected. We don't owe anyone whom we have to pay back the money as a result of this transaction. Okay, so we refer to this as an owner transaction. So the owner in this particular case contributed cash, and then the bank account increased. The owner could have contributed motor vehicles, and then the motor vehicles account would have increased. The owner could have contributed computer equipment, then our computer equipment would have increased. The owner could have contributed land or anything, then that account which he contributed would increase. And all of that would be considered capital contribution by the owner. So it's not always cash. It's not only cash, right? It's any contribution by the owner. We just have to identify the form of the contribution. In this particular case, it was cash. So it's bank, right? It could be equipment, it could be machinery. So we have machinery account being debited. Right, so we got to the owner again. In this case now, he withdrew 5,500 from the business. So if you look at this transaction, the first step that you need to do is to identify the accounts which have been affected. And for you to be fluent at doing that, you need to remember those accounts, those various accounts that fall under assets, equity, and liabilities. So if you look at this, the owner withdrew cash. So the bank account has been affected, right? But it's the owner who took the cash for personal use. So the drawings account has also been affected. Now, in the bank, the money has been reduced. So the balance has been reduced by 5,500. And what the owner is taking from the company keeps growing, right? So the drawings have also increased. If he comes again, they increase. He comes again, they increase. So the drawings have increased by 5,500. And if you remember the dead click, these are the accounts which you debit if they increase. Your expenses, right? Your assets, your drawings, if they increase. So in this case, the drawings have increased. So you have to debit the drawings account with 5,500. But the bank account has decreased. Because bank is an asset, it increases on the debit side. When it decreases then on the credit side. So we identify the bank account as decreasing. So it's going to be on the credit. Now, that is a general ledger entry, right? And what's the effect of that transaction or the general ledger entry on the basic accounting equation? So our basic accounting equation here says assets is equal to equity plus liabilities. So one thing you need to pay attention to is that your examiners will not always, right, present it in the form of assets is equal to equity plus liabilities. This is an equation, so they might say equity is equal to assets minus liabilities, and you have to do the filling using this. So if you haven't paid attention, you will write wrong things because you assume this is going to be assets, this is going to be equity and liabilities. They've played it around. Okay, they could say assets minus liabilities is equal to equity, like that. So you need to be able to read the format that they want you to present it. So in this case, our assets, the bank decreased by this amount, but our equity also decreased because the owner is taking away his investments. His contributions are also decreasing. So there's a decrease. And here we don't owe anyone as a result of that transaction. All right. So it's not applicable. There's no account, then it's also going to be 0. Right. So a drawings is when the owner takes things for personal use. So in most cases, I think I have another example here. All right. So this is another example for the owner. All right. Use the business bank account to pay a telephone bill of 3,500 from MTN. Now remember the entity principle here. The owner has his own telephone bill, all right, his telephone expenditure. The business has its own telephone expenditure according to the entity principle. That is for accounting purposes. So we need to be able to identify whose account was being paid here. Was it business account or was it the owner's personal benefit? According to the entity principle, we need to be able to know whether it was the owner, whether it was the owner's private expenditure or it was the business expenditure. So now this person paid her own telephone bill, not the business telephone bill. Right? So because of that, it's not going to be a telephone expense, it's drawings, right, of 3,500, and our bank has been reduced by 3,500. So what this means is whenever the owner uses resources or uses assets of the business for personal private use, so you could pay school fees for kids, but the business doesn't have school children. It's the owner's school children. But if the business pays for the school fees of its employees, like you are employed and the business pays school fees, then that's an expenditure of the business, right? The owner pays for karate fees. Maybe the owner wants to be feared at work, when she arrives. So she displays this belt and everyone goes disciplined and quiet. The owner could pay her own flat, where she stays, not the business office rental expense, a personal. All right. The owner could donate something for let's say for a what? For a wedding or for whatever it is. All right. So as long as the owner who is taking something by the owner's authority, that's drawings. And what has been withdrawn here is the cash. So it could be even a furniture. If the owner had taken furniture, right, we could have to credit furniture. If the owner had taken inventory that we use for trading, then we would have to credit inventory. Right. If the owner had taken stationery, we have to credit stationery. If the owner had taken whatever it is, we have to credit that. But we always debit drawings because it's the owner's personal private benefit. Now, here is a formation where we start with equity being equal to assets and deduct liabilities. All right? So how do we deal with that? So drawings for under equity, they have increased. Right? The drawings have increased. As a result, equity is going to decrease by 3,500. Our assets have decreased. The bank account, the balance in the bank account has decreased. And then our assets, of course, have also decreased. This transaction does not affect liabilities. Therefore, the amount is 0. So I want you to pay good attention to drawings because these are part of owner transactions. It's very confusing to students. Students would want to say it's a telephone expense here, not drawings. Right? But it's only a telephone expense if it's the bill of the business. All right. Then we can say this expenditure is for the business, and the form of expenditure is telephone expenditure. Right. In which case, our equity would decrease because it's an expense has increased, expenditure has increased, which is not good for us. All right, so we would say that for now, right? Now we have another owner. So what happens is that on 29 February, Mr. A South took his personal vehicle that cost him 300,000 in 2018, but we're now in 2020. So he gave it to the salesman for delivery in the business. So the value of the vehicle on the date it was handed over is 250,000. So this is an odd value. What we want is the value on the date that it was contributed. So this is the owner contributing something. So it's capital, 250. It's motor vehicle, which is an asset. So motor vehicles that belong to the business have increased. And motor vehicles fall under assets. So if any account that falls under assets increases, we go to that account and debit the account. Right? I hope that does make sense. So therefore, our equity is going to increase. Our assets also going to increase. This has no effect on liabilities. Right, finally, we have something here. All right, so this is a case of the owner who wants to buy stationery for office, stationery for his business, the Abdullah's Plaza. So the owner realizes that he doesn't have the credit card of the business. What he has is his own personal credit card. He forgot. So he decides to pay using his credit card. All right. But then he was not refunded his money. So in other words, it's an contribution he made to the business. All right. So if it is contribution, then it's always capital, which has to be credited. And then the form of the contribution was stationery. So you have to debit stationery. And remember, stationery is an expense. All right. So if you want, then it won't affect assets because no assets there are affected. Now there's no asset account. There's no liabilities account. Everything falls under equity. So we have capital. We have stationery, which is an expense. Right. So the capital contribution increased, but then the expenses also have increased. So in other words, there is a zero balance. There's zero. The effect is zero. So one way you can learn this basic accounting equation is that it must make sense, because you're saying assets is equal to equity plus liabilities. So what you get here should be what you get on this side as well, right? So you can't get 100, and on this side you simplify, you get 50. Because that doesn't make sense. So if you look at the transactions we've been dealing with, here we have minus 500 is equal to minus 500 plus 0. Correct. So that actually makes sense, right? So one way you can always check is that it should make logical sense. So if you went through our original first step in accounting, we said one of the things you need is logic. It must make sense. You can't have things that end up like 5,500 is equal to 70. It's not, you know. So you must know that no, I did make a mistake. You can't be surprised that you made a mistake there. Right now we come to concluding this concept of the entity principle. I'm going to conclude that by saying that I'll give you an example. All right. So the owner goes to borrow from ABSA 100,000, and then he contributes that to the business. So we remember this transaction occurred between the business, the owner, and ABSA. All right. And because of the entity principle, we know that the business was not involved. It was the owner and ABSA. So this liability, this loan, is not going to be recorded in the business books because it was between the owner and ABSA. And like we said, the entity principle says we only record those transactions in which the business become a party to, right? In which the business participated. The business is going to be separate from the owner. So whatever the owner does wherever doesn't affect the business until the owner decides to have dealings with the business. So now the owner contributes 100,000. All right. So as a business, we only record the transaction between the owner and the business. So all we know is that the owner contributed 100,000. That's all. If he borrowed, that's his business between him and the bank. The business is not involved. So we won't record that loan as a business. We're going to record bank, right, 100,000. And we refer to that as capital because it's a contribution coming from the owner. Right. So that's all we're going to do. We don't care where the owner got that money from. We just know he contributed. So that's what we care about. So that's the concept of the entity principle. I hope that helps you to try and understand that according to accounting, the business and the owner are two different individuals. The owner has his own bank account, has his own rental expenses, has its own water and electricity. The business has its own business bank account, has its own water and electricity, has its own rental expenses, has its own telephone expenses. All right. So that is the essentials of owner transactions, and I hope you guys have enjoyed that. Okay, so whenever you come across this in your assessment, you must be happy and you must choose you must be able to collect the marks, right? Because that's what we want you to do.